Morgan Stanley and Bank of America ended a mixed earnings season for the major banks Wednesday on a high note. They're cashing in on the M&A wave, producing quarterly profits that beat Wall Street's expectations. At Morgan Stanley, the deal-making boom boosted its investment banking revenue 6%. But like its peers, its trading revenue fell. Morgan Stanley and rival Goldman Sachs have focused on their strength in investment banking and trading. They lack big consumer lending units unlike the commercial banks, and that limits their exposure to pandemic-related loan defaults. Over at Bank of America, record-breaking M&A volumes and loan growth fattened its bottom line by 30%. Billions of dollars worth of deals pushed advisory fees up by more than half to a record, while strong commercial loan growth and higher credit card balances drove average loans and leases higher. But like other banks, it saw higher expenses from bonuses and other incentive compensation. Cutthroat competition has forced investment banks to pay more to recruit and keep talent. But while other banks project expenses will rise further this year, BofA expects to hold the line. Shares of BofA and Morgan Stanley rose in early trading Wednesday. Stocks fell across the board Wednesday, with the Nasdaq finishing in correction territory, having fallen more than 10% from its peak in November. The Dow, the S&P, and the Nasdaq all ended at the day's lows, losing 1% after a choppy session. Investors continue to fret about higher Treasury yields and the Fed tightening monetary policy. Summit Place financial advisors Liz Miller.
We've been up and down all day. This is clearly a market that's trying to figure out its direction. We had huge gains last year, but in fact, they were very narrow gains.
Wednesday's weakness came even as companies reported positive earnings, such as Morgan Stanley and Bank of America. Unlike most of their peers, they bucked the trend by reporting rising profits that beat expectations. The deal-making boom boosted their bottom lines. Morgan Stanley rose 1.8%. BofA gained 0.4%, but other bank stocks ended lower. Procter & Gamble was the Dow's top gainer, up over 3%. The consumer products maker raised its annual sales forecast. It's benefiting from higher prices and a resurgence in demand for cleaning products amid the spike in COVID-19 infections.
Resurgent health worries are proving a boon for Procter & Gamble. That's because they've sparked a cleaning frenzy. Demand for brands like Tide and Mr. Clean has soared. Consumers have stocked up on everything from detergents to surface wipes. Now P&G is raising its annual sales forecast as a result. The consumer goods giant expects sales to rise as much as 5% this year, up from an earlier forecast of 2 to 4%. Over its second quarter, net sales rose to almost $21 billion, beating forecasts. In its fabric and home care division, the firm's biggest unit, they were up 7%. A more intense flu season also saw sales of personal health products jump by around a fifth. It's all a timely boost for P&G, which has been battling surging costs for commodities, freight and foreign exchange. The company says it expects to take a hit of around $2.8 billion over all three this year. Sony shares tumbled 13% on Wednesday. That as investors weigh up a big new challenge from Microsoft. The US giant is buying game maker Activision Blizzard for $68.7 billion. That will give it control of blockbuster games, including the Call of Duty series. The deal suggests Microsoft is bulking up on content as gaming moves from consoles to online platforms, including its own Game Pass service. Wedbush Securities MD Michael Pachter.
Sony are big losers because some of this content's not going to be on PlayStation in the future.
Sony has long been seen as the market leader in consoles. It's also strengthened its list of in-house games, including hits like the Spider-Man franchise. And the PlayStation is a major source of revenue for Activision, potentially complicating the Microsoft deal. Michael Pachter again.
It's an open question whether the regulators will allow Microsoft to exclude PlayStation from the mix. And that's the part that could be an impediment to the deal getting done.
Long-term, both Sony and Microsoft have an eye on new rivals like Apple, Amazon and Facebook. They all see games moving away from bulky consoles to become a purely online experience. The winner then will be the one with the best content, not the best hardware.
Britons are beginning to feel the squeeze on living standards. New figures Wednesday showed inflation jumping to 5.4% in December, its highest in nearly 30 years. Prices for food, hospitality and household goods were the main factors. Fuel prices, which were the key driver in previous months, remained at their recent highs. Now all eyes will be on the Bank of England. The soaring cost of living is putting pressure on the BOE to raise its main interest rate again. Last month, it became the first major central bank to tighten policy since the start of the global health crisis. Interest rates rose to 0.25% in December, with financial markets pricing in a more than 90% chance that interest rates will increase to 0.5% in February. And further pressure is expected on inflation in April, when a cap on energy prices will go up and household energy bills could rise by as much as 50%. Many economists now think price rises could hit 7%. And it's all a mounting problem for the government, which faces growing calls to offset the rise in energy bills.